Welcome to the IRS Debt and Audit Podcast with Brian Loughrin.
Hey everybody, welcome back to an all-new episode of the IRS Debt and Audit Podcast with Brian Loughrin. I'm your host, Mike Leon. Brian here is a seasoned tax attorney with over 25 years of experience helping small business owners and self-employed professionals resolve serious IRS problems. He's based out in Tampa and representing clients nationwide, and he's focused on federal tax controversies, audits, complex debt resolution, even before the U.S. tax court. In today's episode, we're going over the ways that IRS tax debt can be resolved. There's a bunch of options. Brian's going to walk us through all of them. So, Brian, good to see you as always. Before we get into the options first, let's talk about why it is important for business owners to know all the ways how they should handle IRS tax debt.
All right. Thank you, Mike. I think for a lot of people, when they finally realize that they've got a debt they need to deal with, it could be the very first notice, or it could be somebody that's been putting it off for years. I think most people are familiar with those commercials. They're on television, radio, certainly emails and robocalls. The pennies on the dollar. Settle your debt. Call 1-800 whatever tax slayer, 1-800 tax what have you. I call them 800 number companies, and they promise that, the 10 cents on the dollar, settle your debt, and so forth. And people say to me when they call me, they go, "Well, is that true? Can I really do that?" And I say, well, it's possible, but it's not as simple as that. It's not just you ask for it, you get it. If it was that way, everybody would do it. I'd do it. Who wouldn't do it? Everybody would run up a big tax bill and then just settle it for 10 cents on the dollar. You have to qualify for those programs. And again, they'll say, well, are these places illegitimate? And I say, well, even a broken clock is right twice a day. So it's not that they're 100% wrong. I just think when they approach the general public promising something, there's no way they can know if that person qualifies. But that's usually the first question I get from people. And who wouldn't ask it, right? It makes sense, right? If I could settle my debt, 10 cents on the dollar, pennies on the dollar, I would do it. Right. But for most people, certainly people that are still working, not people maybe moving into retirement or elderly or seriously ill. For most people, you're going to solve your tax issue through some type of payment plan or what's called installment agreement. And that's the vast majority of our clients.
Brian, let me ask you, you just mentioned the programs if people qualify for them. What's the first program that comes to mind for you or solution for clients that resolves significant tax debt?
The first program is whatever the conversation leads to. So that's why when people call in, I'll ask them to tell me what their situation is. And I'll try to get a feel for where they are today and where they may be next year. Are they working? What is their age? Are they in a situation where their income may be going down substantially, or is it going to go up, or are they just going to continue on their path? So the answer is it depends upon the individual situation. There's not an automatic one-size-fits-all solution. But at least in talking with people, they'll tell me where they are. And then from there, I can start sharing what might be some of the options based upon that preliminary information.
I'd love to go into one option specific with respect to installment agreements. Can you kind of explain for folks how that works and when it makes sense for a business?
Well, for business or individual, the situation with installment agreement is essentially, and I'll use round, simple numbers for the purpose of illustration, okay, just to kind of put a number out there that people can work through their head as they go through this. Say somebody has a tax debt of $80,000 over the course of a few years. They'll say, well, what kind of payment can I get? And I say, well, with the IRS, it's not like buying a boat or a car or something at a certain set price, deciding how many months you want to pay it out, and there you go. It doesn't work that way. With the IRS, when you're talking about installment agreements, and again, these are balances, substantial balances, things definitely above $25,000. The IRS will look at what they call ability to pay. And people say, well, what does that mean? I said, well, kind of just what it sounds like. What is your ability to pay? And the simple formula is income minus what the IRS calls allowable expenses, which would be things such as rent or mortgage, car payment, utility bills, food, personal care products, and so forth. So you don't just automatically look at a balance and then divide by X number of months and say that's my payment. I think of a situation quite a few years ago where I had two different individuals come into my office, really only a few days apart, and they each owed roughly about the same amount. I think it was around $50,000. I was able to set one person up on a payment plan of, I think it was $80 a month. The next person, their payment plan was just under $5,000 a month for the same type of balance for roughly the same tax periods. People say, well, how can that be? How can there be such a variance? I said, well, the first guy was moving towards disability. He wasn't really going to work anymore. His income was very low, but could come into around $80 a month. The other person was a surgeon. And the guy was making, I don't remember at the time, $800,000 a year or something. And so the IRS said one person's ability to pay is $80 a month, and the other person's ability to pay is roughly $5,000 a month. So it's not a one size fits all. And this is where the heavy lifting comes in, because I tell people, if you leave it to the IRS to tell you how much they think you should pay versus how much you think you can pay, I can guarantee you it's going to be a number a lot higher than what you expect. And that's really the value in what we bring to assisting clients with installment agreements.
So, piggybacking on that, it sounds like they take into account obviously the situation. Maybe they would even agree to like partial pay installment agreements. Can you kind of explain how those work in practice? Why would the IRS agree to accept less than the full amount that's owed?
Because the IRS is no different than any other creditor. If somebody borrowed money from you personally, and you're like, well, I need you to pay me back. I mean, you're going to try to get all of it back. But if at the same time, realistically, you're not going to be able to do that, you might want to say, well, let's take this amount back. I want to get something out of it. A partial pay installment agreement simply means that the IRS knows they're not going to be able to collect the full balance. So they'll accept what they call a partial pay. And it's usually configured on a monthly basis, because that gets them some of the money. But again, it boils to individual circumstances. It's income, it's expenses, it's living arrangements, any type of medical concerns, just various things that all factor into it. But yes, in many cases, the IRS will consider taking less than the full balance. And I want to touch on that for just a moment, and Mike, and by saying that the IRS essentially has 10 years to collect from the time the balance gets on the books, or the balance is assessed, is what they call it. That starts a 10-year clock. Now, that's not a 10-year atomic clock, which you can just tick off the days no matter what. It's a 10 years that will stay at 10 years unless there are circumstances that change it. Certain things, if you file, say, for instance, bankruptcy, or you file for offer and compromise, or you file for innocent spouse, those things can stretch or toll that 10 years. But it's generally a 10-year window. And so, and remember, it's 10 years from the time the balance gets put on the books, not 10 years plus the calendar year. I just had somebody come in recently. They have a balance for 2014. Guy says it's 2025. How come they still owe? Well, it turns out he didn't file the tax return until 2018. So they have until 2028. But in those instances, the IRS looks how much time is left, and they're going to take something if they can. But here's what I tell our clients. Don't leave it to them to tell you. Okay, we'll work with the IRS. We'll figure out what's best for you and your circumstances, because it doesn't make sense to put somebody in a situation that is so onerous or so financially draining to the person that they simply can't sustain it. And we won't let that happen to our clients.
Brian, you just mentioned offer and compromise. So I would love for you to explain that term. What is it? When is it realistic for a business to qualify for that?
Well, offer and compromise is basically just what it says. You're making an offer and you're compromising how much is owed. And that dovetails back to those commercials that people see on TV or on the radio and so forth about pennies on the dollar, pennies on the dollar. If you qualify, it's a great program. I tell people in some cases, it's like qualifying maybe for food stamps. If you qualify, who doesn't want food stamps, right? I mean, free groceries. Offer and compromise is much the same way. Pennies on the dollar. Usually roughly 10, 20% of the tax debt. In those cases, you're looking at a situation where it's clear the person doesn't have the ability and won't have the ability to full pay the balance in the amount of time that the IRS has left to collect. But an offer and compromise looks at a number of things. It's a very complicated process, but it looks at assets, it looks at earning ability, a lot of various things. But if you qualify, it really is a great program. I do want to say one thing about an offer and compromise, and I get a lot of calls on this from people that say, listen, I was put into an offer and compromise, everything was going well, and then all of a sudden I get this letter saying I owe all this money back, I don't know what's going on, I can't get a hold of this company, whatever. And as it turns out, there's certain requirements for an offer and compromise that can extend even past the time that the person goes through the offer. So when you call our office, we'll walk you through it and let you know, because if it is a viable option for you, It's a great way to resolve your debt.
Brian, another term that I heard was currently not collectible. I'm going to assume that that means what it means, but I would love for you to explain what that status is and what does the IRS look for before granting that?
They look at income, starting with that, and they look at what they call ability to pay. And there are a lot of people out there that have had a good income, and then things have changed for various reasons. A lot of times it has to do with illness, just various circumstances. And all of a sudden they're at a point where they used to be making whatever. Maybe they're making $200,000 a year, and they fell behind in their taxes. And all of a sudden they're making $40,000 a year. Well, they don't have the ability to pay anything towards the past due balance. And so the IRS will say, okay, fine. Currently, you're not collectible to the extent that we're not going to try to enforce collections by intercepting a payroll or doing a bank levy. Doesn't mean you don't owe the money. Whereas in an offer in compromise, once you pay off the agreement, then you don't owe the money. Currently not collectible means you still owe the money, but we're not going to try to actively collect it from you because you don't have the ability to pay. Um, I use a simple example. It's kind of like having that deadbeat relative that borrows, a couple $1,000 from you, and he says, "Hey, man, let me $2,000. I'll pay you back in a couple months," and this and that. Well, a year goes by, you can't get a hold of him, you don't hear from the guy, he's not paying you anything, won't call you back, and you realize you're rolling up on a holiday dinner with the relatives, and he's going to be there, and you say, "Man, I can't wait to see him. I'm going to go up on him, and I'm find out where my money is and so forth." And before the dinner, you find out that he lost his job, his wife left him, his dog died, his car got repossessed, and he just got out of jail. And the guy's sleeping on people's couches. Now, does that mean that you're going to go up to him at a holiday dinner and hit him up for the money? No, I mean, that's pointless. Doesn't mean he doesn't owe you. Okay, he still owes you the money. So if 2 weeks later you find out he hit $10,000 lottery ticket or something, you're going to go try to collect from the guy. So you're not out of the woods, but at that point. But I will say this: for the vast majority of our clients that get put in CNC status, that's where they remain until the balance is exhaust, until the time frame runs. The vast majority of people, because CNC is oftentimes something that is not going to change for our clients. And again, based upon medical conditions, age, ability to earn, different things like that. So CNC has been a lot more realistic and viable alternative for people not able to pay, much more so really than an offer in compromise, which isn't granted as often as a lot of people would think.
No comment on the relative part from me, but I will ask you because it funnels into penalty abatement and how does that work? Why can it make a big difference in respect to total amount that's owed to the IRS?
When people get a bill, and these IRS notices are not done by people with MBAs in marketing. You're not going to get color-coded pie charts and little cartoon characters on them and so forth. These are like boring black and white government documents that in some cases don't make sense. They do if you know what's in there, like we do, but for the average person, it doesn't make sense. So they'll see a bill and they'll say there's a large tax debt. Well, they'll say to me, "Look, this bill is 8 years old. The tax was pick a number, $20,000, and they're wanting $44,000. They're saying, oh, they're charging me all this penalty and interest and so forth." And that's true. And people say, "Well, it's just the tax was 20." I said, "Well, yeah, back then, if you'd have paid it, that's all you'd owe. Unfortunately, you didn't. But a large portion of that is penalty, and penalty can run roughly 20% of the unpaid tax, and in some cases, even up to 25%. So when we take on a case and we start getting the transcripts we need, we'll determine if penalty abatement is a viable option. And if it is, obviously, we're going to pursue it, because if you can get the penalty waived, or what the IRS calls abated, if you get it abated, then you have a situation where not only is the penalty taken off, but the IRS charges interest on the penalty, just like they charge interest on the tax. So if you get the penalty abated, not only will the penalty go, but any corresponding amount of interest with it will also be taken off. And in some cases, you're talking tens of thousands, if not hundreds of thousands of dollars. But it's always something we look at in every single case.
Brian, you just mentioned in one of your answers before about bankruptcy. When is that an option for resolving tax debt? When is it on the table for a business owner?
Well, we don't do bankruptcies here. So if it comes to that, we'll make a referral out. But I will say this: just the simplest, generalist rule on bankruptcy, and I'm talking like Chapter 7 bankruptcy, which is the one where you discharge the debt, get rid of the debt, not Chapter 13, which is just a restructure. But just as to Chapter 7, what I tell people is the simplest rule to remember is the tax has to be assessed or on the books for a minimum of 3 years. Again, don't look at the calendar year. Don't say, oh, 2020, that's 5 years ago. Well, if you didn't file the return until 2023, that's when the 3 years starts. So it has to be assessed or on the books for a minimum of 3 years before it'd be eligible for Chapter 7 bankruptcy. And it may be. And one other important distinction, we talked about this in a prior episode, and that is where if somebody doesn't file a return, sometimes they'll receive a notice from the IRS that says, we're getting ready to submit a return based upon your income information. And we're going to do a substitute return based upon that, computer generated. Keep in mind, if you are subject to a computer generated SFR substitute for return, even if later on you correct it by filing the original return and getting it all straightened around, if it is originally submitted as a substitute return by the IRS, then it's not eligible for bankruptcy. So those are really the two main things. But if people are thinking bankruptcy, I'll ask a few general questions, and then at that point, if need be, I'll make a referral to a bankruptcy attorney. But again, we don't do that here, but in some cases, it is an option.
Brian, let's land the plane on this. What's a piece of advice you would give for folks that are trying to decide between these type of solutions, if it's the right fit for their particular business?
Well, I just tell people, give a call to our office and we'll talk to you. And we fielded so many calls over the year. I feel like we know what questions need to be asked to really get an overall view of what your situation is and what might be the best alternative. Sometimes we don't always know on a phone call. Sometimes it takes getting involved directly in the case. But I'll say this, if you have a tax debt, anything will fix itself. And so if you're getting those bills or notices, regardless of whether it turns into an offer in compromise, currently not collectible, installment agreement, what have you, you need to take action because it's better to go to the IRS before they come to you.
Always better to go to them before they come to you. Brian, I can't thank you enough for the time and insights on this. I truly appreciate it.
Thank you, Mike.
And thank you, everybody, for listening to another episode of the IRS Debt and Audit Podcast. If your business is struggling with IRS tax debt, knowing your options is the first step to relief. Do me a favor right now. You want to schedule a consultation with Brian and his team, visit tampataxrelief.com. If you like this episode, leave us a comment, review, like, subscribe, share it to somebody who needs to hear it. As always, I'm Mike Leon. We'll see everybody next time.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.